We had those reciprocal tariff announcements, as you know, April 2nd, and I was pretty confident that we were going to at least have that in place until it wasn't going to change until we got to the 9th. And then when the 9th, of course, struck and they were in place shortly thereafter, the president announced there'd be delays. And I see that because the negotiation process had been done. So you need to come with these tariffs that were very high, very aggressive, and then in the process that was bringing people to the table. And now the negotiation has begun. To me, the maximal amount of uncertainty in some sense with tariffs was earlier this week before that announcement occurred. And now we could just go forward. And my guess is the president is going to make deals with various countries, and that will be to the U.S. advantage, and we're going to kind of clean up this uncertainty, and then we'll move on to the next thing, which would be the budget and what spending cuts, if any, and how they'll impact or help the economy. But I do think this tariff uncertainty will pass. I think the market has. I understand why the market's reacted the way it has. I don't expect it to continue. I do expect the volatility to subside as progress on trade negotiation moves forward.
But it's not just about the market activity, right, Joe? It's also about consumer and business activity, who, while they're waiting for clarity to see what the outcome is 90 days from now, they still have to make decisions with their own purchasing power now, decide what they're doing in terms of inventories, where they're sourcing the supply, what purchases they're making. How much damage realistically can be done, even if you think ultimately we end up at a better place at the end of the day, or at the end of this period, I should say. We still have the whole period to get through.
No, absolutely. And this uncertainty, even as it relates to tax policy and the budget, is also a factor. Right now, it's just been a very relatively short period of time. If we're looking at the labor markets, the jobless claim numbers are low. If we're looking at the consumer spending side, the chain store numbers look pretty good. If in the next week or two, there is progress on the trade, I don't expect this uncertainty to really meaningfully have any long-lasting or appreciable effect on the economy. The economy is very resilient. It's very robust. It will come back. If we go 90 days or we're day 89 and there's been no progress made, yes, absolutely, that'll be a problem. But I don't expect that to be the case. I do think my hunch and gut tells me we're going to get some good news somewhat soon.
Joe, about the kind of inherent inflationariness of all of this, I'm curious sort of how you're looking at this. John Williams is speaking at the Puerto Rico Chamber of Commerce right now. He says that his expectation is that these tariffs are going to boost inflation this year to 3.5–4%. We've heard from the president's economic advisors during this term a sort of more greatly reduced sense of the inflationary impact this is going to have. What's yours? How do you marry your kind of forecast with what I just mentioned there, what we heard from President Williams of the New York Fed and the White House team today?
We've been of the view that energy prices will come down. That'll be a very powerful offset, especially to what I think is still likely to be a modest impact from tariffs. So, for example, if you had a 10% across the board tariff, 60% on China, as the president had proposed on the campaign trail, that doesn't even lift in price level terms your CPI more than a point. And of course, it'd be offsets from the currency and offsets from the margins. But on the inflation side, the fact that oil is down at 60 is very encouraging. That might have been due to the administration pushing the Saudis in particular to increase oil production. That will provide an offset. So, I mean, the inflation outlook right now is still uncertain, it's still sticky. The Fed is, I think, looking too much in the rearview mirror on this stuff, because if you look at the markets right now, they're telling you, looking at break evens, there's no inflation problem. And that's also, I think, one of the reasons why the market is behaving. Risk assets have not behaved as well today, is they've listened to Fed commentary from President Williams and think that the Fed might be making a mistake by harping too much on the inflation side and less on the potential growth side, meaning the economy could be slowing. That's what more investors are worried about right now than inflation.
Well, have you changed your own expectation, Joe, for the kinds or the scale of Fed rate cuts we could see this year, the number of them?
No, we've actually been pretty stable. I mean, we marked our growth down based on what will be the weak Q1. We've got GDP around 1.5%, and with most of that weakness concentrated in the first quarter. We did raise our inflation forecast a bit, but not massively. And we kept the Fed basically not cutting until the second half of the year, which is where we've been for a while. I don't think the Fed needs to cut in the short term. I don't think the Fed should cut in the short term. And therefore, we see no change. You've got two cuts, one 25 in September, another 25 in December.
I want to ask you about dollar weakness, and Kayleigh just a moment ago kind of running through a number of the pairs indicating we're seeing softness in the dollar today. And again, drawing on your experience during the first term, I wonder sort of what insight you can give us into the way in which the president looks at the strength of the dollar relative to other currencies. Of course, there's this conversation maybe swirling in the background still about this prospective Mar-a-Lago Accord getting folks to the table there. It seems like in this current environment with the lack of communication between the U.S. and China, that would be a difficult thing to pull off, to say the least. But what's your sense of the outlook here from Washington on global currencies, the way that this president is looking at the dollar today?
So in general, the trade weight, if you look at the Fed's real broad trade weighted dollar, it's close to a 40-year high. So this notion that the dollar is expensive, you see it in the Fed data. Investors tend to focus on the DXY, as you could pull up on your Bloomberg terminal, which is a very narrow nominal basket of currencies, and that's been a bit weaker. Over time, I could see the dollar perhaps softening a bit, but for good reasons. On things like the Mar-a-Lago Accord, I don't know if that's going to happen. I'm just not privy to those discussions. I think given the president's love of branding and marketing, it'd be hard for me to think that there isn't a Mar-a-Lago Accord at some point, but what it entails, I don't know. But just for a minute on the markets, right now we're clearly in a very sharp deleveraging period. And I wouldn't be surprised if some of this selling just naturally burns itself out, especially as we get more chatter that, hey, look, the administration with its trading partners is making some progress. And ultimately, my base case for the economy, because I'm still an optimist, is that there will be a deal reached with China as it's in both countries' best interest. And I think the Chinese will want to negotiate, and the president, having had some successes with other countries that will precede those actions, will basically push China to do so.
I want to ask you about the bond market as well, though, Joe, because obviously that is, we understand what caught the president's attention enough that he was actually inspired to do a little bit of a policy shift with this 90-day pause on reciprocal tariff rates. When you see the kind of activity we've seen in the bond market, the upward pressure we're seeing on the 10-year yields, is that something you attribute mostly to this back and forth over tariffs, or does that signal something else to you about whether or not U.S. Treasuries are seen as the kind of safety asset that they once were, considering the other kind of fiscal trajectory-oriented issues that the United States is still grappling with, knowing we have a debt ceiling fight potentially ahead of us, that we're going to be looking at a tax package that could increase the deficit if there's not enough spending cuts to offset it. How much is that factoring into what we've been seeing?
So there's a lot there to unpack, but on the 90-day, I don't know if I can remember everything, but on the 90 days,
just explain the bond market to us, Joe.
Okay, so I think so. On why did the administration make a very quick pivot? And to me, this is my own 2 cents. I'm just trying to figure this out, piece the puzzle together. But Kevin Hassett was rumored to have set a 90-day extension on Friday. That was well before the bond market had sold off sharply. And coming in Monday morning, the bond market, the 10-year note was at 385, and then since had a big move after. I think once there was chatter among the various parties that there would be negotiations starting, my guess is the administration said there's no point at this point in not suspending for those countries that want to negotiate with us now. What are we gaining by waiting? Now, I don't think it was the bond market. I don't think it was necessarily the equity market. I think it was just a whole array of factors. What are we getting? What are we benefiting from? If we're having a conversation, let's try to provide some clarity by having that negotiation now. In terms of the budget, what I'm interested in seeing is, does the Senate parliamentarian, how does she attribute the scoring? Are we going to go with current policy, or are we going to go to current law? Because those deficit numbers the CBO has, we could debate what the number will be, but the numbers they have on paper simply do not make any sense, because a policy that's been in place for over 7 years that has given us revenue share of GDP in line with its long-term average is not going to create by itself a shortage of revenue and larger deficits. What will be is if we have a recession, which I don't expect, and then what happens, of course, on the spending side, that's up for debate. I have no idea what happens on the spending side. I'm hoping we could find some common ground and make some cuts, but that we don't know, and we won't know anything until Congress comes back in 2 weeks following the Easter holiday.